Good afternoon, ladies and gentlemen, and welcome to our third and final Efficiency as a Service Capacity Building webinar. In today's webinar, we will look into the financial and accounting implication of engaging in an Efficiency as a Service agreement and the financial challenges supplier of Efficiency as a Service face when wanting to implement and scale up such a business model. Most often than not, an Efficiency as a Service agreement will involve the support of the financial partner in order to overcome these challenges. Our speakers from the financing sector will share some of the financing mechanism available to Efficiency as a Service supplier that need to pre-finance the equipment that is supplied as a service. They will share also their perspective with regards to the risk and opportunity when it comes to such a business model, as well as some consideration that needs to be taken into account in order to maximize the chance of securing a partnership with a financing partner, in other words, to make the project bankable. We will also address a topic that is very often raised, which is the qualification of an Efficiency as a Service agreement under Belgium GAAP and IFRS, so whether or not the agreement would qualify as a lease or as a service, and the impact that may have on the customer and on the supplier balance sheet. So for those of you who have missed our previous webinars, we had our first webinars on the 27th of April on the successful path to servitization, in which we looked into the market trends, challenges and success factors in relation to the transition from a transitional sales model to a service-oriented business model. We had also our second webinar earlier this week on the contractual framework, energy policy, and property law. We dedicated one part of the webinar to the loss of ownership risk an EaaS supplier may face as a consequence of a certain interpretation of the Belgium law, with a focus on real estate sector, and looked into the building lease as a possible solution to tackle this risk. We also presented the rights and obligation of customers and supplier under an Efficiency as a Service agreement. And we covered the legal framework for energy communities, energy sharing and flexibility, and the opportunities and limitations for Efficiency as a Service project developers. So the recording of these webinars are available on the Efficiency as a Service YouTube channel. My name is Mirataya. I'm a circular economy expert at Agoria, and I'm joined by Dimitris Karamitsos, who is a senior energy efficiency business developer at BASE, the Basel Agency for Sustainable Energy. Agoria is the Belgium Federation of Technology Company. Dimitris and myself will be your host and moderators for today's webinar. And I am very pleased to welcome our speakers for today. Our first speaker is Christian Levie. Christian is Deputy Managing Director of Econocom Lease at Econocom Belux. Christian is also an executive board member of the Belgium Lease Association and has a career of over 30 years in financing and leasing. Our second speaker is Baptiste Desbois, who recently joined BNP Paribas Fortis Sustainable Business Competence Center as a senior advisor for clean and green tech. Baptiste's role is to accompany customers in their transition towards sustainability, with a specific focus on energy-related topics such as solar panel, wind turbine, biomass batteries, etc. Baptiste is an engineer with more than 10 years of experience in the energy sector. And our third and final speaker is Thomas Carlier. Thomas is an audit and insurance partner at Deloitte. Thomas is heading the Brussels IFRS EaaS Center of Excellence and has 20 years of experience in financial reporting with a focus on IFRS, EaaS, and Belgium GAAP. Thomas is responsible for the IFRS quality review process applicable to public interest entities that Deloitte is auditing in Belgium, and acts as a direct IFRS advisor for large Belgian listed companies. So some practicalities: the webinar is being recorded and we will share the link with you in the coming days. We will have a Q&A session at the end of the webinar. So please do use the Q&A function if you have any questions to address to the speakers. If you would like to address a question directly, you can raise your hand and we will unmute your microphone. So before I give the floor to the speakers, I would just like to give a few words about the Efficiency as a Service project in the context of which this webinar is being organized. So the aim of the Efficiency as a service project is to accelerate the market adoption of energy efficient solutions by enterprises through a pay-per-use as a service business model. The efficiency as a service project is taking place in Belgium, in the Netherlands, and in Spain. Agoria, we are the country coordinator of the project in Belgium, and BASE is the overall project coordinator. And the project has received financing from the European Union Horizon 2020 Research and Innovation Program. So the overarching objective of this project is energy efficiency improvements. And here the idea is to tackle in various segments of the economy. So we're looking at the industrial sector, but we're also looking into the building sector, I would say. Efficiency as a service is seen as a means to an end, or to that end, in that it enables to lift some of the market barriers that prevent companies to invest in highly efficient technology, mainly due to the fact that these technology have quite higher upfront costs than less efficient technologies, and companies often want to focus their investments into their core business, and energy efficiency is not always an investment priority for companies. So within the project, what we want to do is to support, on the one hand, companies that want to develop or deploy an efficiency as a service solution. So for that matter, we have developed a toolkit that you can download from the Efficiency as a Service project website. There's a link to the website that you will find at the end of the presentation. And part of this toolkit is a standardized efficiency as a service agreement. This agreement served as a supporting document for a company that wants to develop their offer, because there isn't any real developed legal framework to guide companies in that, and such contract or agreement can be quite complex. So the aim is to have the contract as a guidance, but also the aim is to decrease the risk perception that such a business model face with regards to the financing sector, but also the customer. So when developing the standardized agreement, the idea was to develop a balanced agreement between the supplier and the customer. But what we also are doing and would like to continue doing is engage the dialogue with the financing industry to also make sure that from the financing sector, this standard tackles the risks that concerns the financing sector. So in addition to that, what we would like to do also is support the development of pipeline projects by connecting efficiency as a service enablers to efficiency as a service providers. When we talk about efficiency as a service enablers, are organizations that can partner with a provider to enable him to improve or just develop his solution. So it could be financing institution, insurance companies, but also organization or companies that can offer monitoring solution, automation solution, digital solution, etc. So the idea is to be able to connect these two, but also to connect efficiency as a service supplier and potential customers. So if you are a provider or interested in developing an EaaS offering, or if you are an enabler, do get in touch with us so that we can see how we can support the deployment of such projects. I've talked a lot about efficiency as a service. So when I talk about efficiency as a service, what does it mean? If we look at a traditional sales model, it's the customer that is basically responsible for the purchasing of the equipment, so the financing for the life cycle of the equipment, so the maintenance, the performance, etc. Whereas when we look at an efficiency as a service solution, it's basically the supplier that it takes on the full responsibility related to the equipment. So the design, the installation, obviously the financing of the equipment, because there is no transfer of ownership from the supplier to the customer in that case. And the supplier is also responsible for the performance of the equipment, for the monitoring, for the maintenance, servicing, and for the end of life of the equipment. And so the supplier bundles in a way everything into a single solution that is offered to the customer, and the customer simply pays a monthly fee to the supplier. Within the agreement, the standard contract that we've developed, it's a pay-per-use business model. Obviously, there are various types of agreement that can be made, but within the context of the contract or the project, it's a pay-per-use model. So a final word, just to stress that, or to highlight that efficiency as a service is something that we want to encourage also because it's a sustainable and triple win business model. From the customer perspective, the efficiency as a service business model allows him to access the most efficient equipment without having to put any upfront investment. It's also about unburdening the customer because the customer gets to outsource the operational, the maintenance, but also the performance. And so the associated risks, and the customer benefits from improved efficiency and uptime. From the provider point of view, such a business model enables him to improve in competitiveness because then customers can easily access these equipment that have higher upfront costs. It's also a way to be able to access new market opportunities, but also to have more predictable and continuous revenue streams, and to increase customer satisfaction and retention. From an environmental perspective, there is obviously the energy efficiency component, so the climate component, but also there's a resource efficiency component to that, because the efficiency as a service model is conducive to circular economy, because of the fact that the supplier remains responsible for the whole life cycle of the equipment, and because there is no transfer of ownership of the equipment to the customer, there is an incentive for the supplier to build equipment with a longer life, and to also consider second life of the equipment when designing the equipment. So this is for my part. And now I would like to give the floor to Christian Levie, who will give you a presentation on the financing and accounting application of efficiency as a service. Christian, the floor is yours.
Yes. Thank you, Mira. Good afternoon, everyone. So indeed, I will speak about this subject. Just a practical about the slides.
Yes,
Do
Christian?
I have to manage the slides, or?
Yes, yes, if you can share your screen.
Oh, sorry. Just a moment. Good. And then sharing will be share screen. Do you see it?
Not yet. Yes.
Yes?
Yeah.
Okay, good. Thank you.
You'd have to put it in presentation mode, but
yes.
We can see it.
This way. Okay, good. So just a quick word about who is Econocom. Econocom is a digital company, technology company, active in 3 fields of expertise. One is we are a provider of technology equipment, IT, servers, PC, laptops, portable and mobile devices. Secondly, we have also a very important service business line, providing services for customer, helping them to manage their fleet. So it's outsourcing, data management, migration, cloud, and so on. And also we have a financial business line helping customer in pay-per-use, as a service, and leasing solutions. We are a company of more than 8,000 people, present in 18 countries in Western Europe and North America. We are managing 7 million of technological assets and we had last year a revenue of 2.5 billion. In Belgium, we have been committed to the development and acceleration of the circular economy. We are a member of a certain number of workshop initiatives like the Vlaanderen Circulaire, so Flanders Circular Purchase process, also the Green Deal Circular Build. In the Belgian Leasing Association, we have also published a charter on acceleration of financing of circular economy. I'm member of the board of directors. Econocom is also, by this technological character, a member of Agoria, and we achieved earlier this year an award and a certification from VITO, the Flemish Association of Small Companies. All in all, what's the subject of today are the financing and accounting implications of as a service model. Very simply, from the supplier point of view, I will mostly today focused on the supplier point of view, that most of the challenges are on this side and less on the customer side. Basically, when you are offering an equipment as a service solution, in most of the cases, you stay owner of the equipment, you keep the equipment of the balance sheet, so it means that your balance sheet is expanding. Rather than selling and getting immediately the assets out of the balance sheet, they stay out in your balance sheet, and it has very strong implications. Secondly, also, you will probably have to spread your revenue over time, because and as a service, the service components are very important, and that spreads revenue over the time. What means that if you are converting from a sale model to an as a service model, if you convert some of your sale in service, it means that your revenue will decrease. So you will be in a certain way squeezed, because you need money from your bankers to buy equipment. You have more assets and more debt on your balance sheet, and on the other side, you have less revenue. So you will need more debt and more financing needs with less revenue on your balance sheet. So that it's a quite difficult and challenging situation. Also on your organization, ERP and so on, you will move from one single one-off invoice from selling the equipment to 48, 60, 84, 120 recurring invoices, and also all the work around it by making invoices, doing the cash collection, and in most of the cases also you take a credit risk on your customer, which is fundamentally different. When you sell equipment, you get your equipment, and maybe you have a 1 month credit risk on your customer. If you have a 5 years, 6 years, 7 years contract, you have a credit risk for 7 years on your customers. That's something completely different. And also at the end of the contract, you take back the equipment, so you will have to organize logistics, you will have to organize repair, refurbishing, second life. So it's also more work and different. So all of those 4 items you will be confronted with financing issues. And basically, hopefully there are solutions, and indeed there are solutions. Which solution can be a little bit the ideal one is that you can offer as a service, but you don't have the burden on your balance sheet, you don't have more assets, and you don't have more debt. Also, you offer an equipment as a service, but you still can book revenue as quickly as before on your equipment. You will have to maybe find a partner to outsource the problematic of sending the invoice, taking the credit risk. And if you have a partner, it will make your life easier. And at the end of the process, if you also can co-create and have a partnership with someone to help you reorganizing the retro logistic, the second life, and so on. Is that an ideal world? No, it can happen and it can exist, and it has been shown on the market that there are proved solutions to do it. basically, on the accounting side, the more and fundamental question will be, is it a service or is it, can you read my slide because I see it twice? Yes, like this. Is it a lease contract or is it a service contract? In most of the energy as a service contracts and solutions, you will not find the word lease or you will not qualify it as a lease. But of course, the definition of lease is quite broad. And lease is defined as making equipment available to someone against a payment. And of course, when you make energy as a service, the people are interested in the energy, but they need an equipment and you need to provide an equipment. So there is somewhere what we call an embedded lease. So it's a lease which is not named as a lease, but which has the characteristic of a lease. And basically, the lease can be on balance sheet or off balance sheet. If it is on balance sheet, you will have CapEx assets and you will have a debt. If it is off balance sheet, of course, you don't have. And this qualification can be also for the supplier and for the customer. Both of them has to ask themselves the question. I will not go in too many details. Thomas will speak about it in more detail, but I've seen that he's speaking about the IFRS, so I will cover quickly the Belgian accounting standards. In Belgium, it's quite easy, it's more simple than in the IFRS. And basically, you have a simple criteria about qualifying a contract as a lease or not as a lease. If the present value of the stream is higher or not than the price of the equipment. Of course, as a service model, maybe you will have to ask yourself which component of the total price per month is for the equipment and which components of the total price is for the services. But then you will have to make some computations. Also very simple to see, do you have a purchase option or don't you have a purchase option? As Mira said, in most of the energy as efficiency as a service contract, you will not have a purchase option. And if there is a purchase option, is the purchase option lower or higher than 15%? If you have a contract with a higher present value of streams, if there is a purchase option, and if the purchase option is lower than 15%, under Belgian standards, that contract will be qualified as a lease and more as a financial lease, by which the accounting rules are very different. And you can call your contract a service. Maybe it is a lease and you will have to consider is at financial lease. On the other side, the IFRS, very quick. I will not repeat what Thomas will say, but in the IFRS, what is very important is the substance over form. It's not the name of the contract which determines the qualification, but the characteristics. What is it really? And then some criteria of who is in control of the asset. So who is choosing the brand, who is choosing the model, who is choosing the specs, the specifications, who has the right to decide when it's working, when it's stopping, when it's maintained, and so on. Also, how specific is the equipment for the customer? Do you offer a quite generic equipment to the customer, or do you need to make it very specific, for example, for his buildings or for some accessories? And then in this contract, as the supplier, the right to change the equipment. For example, to optimize the energy, has the supplier the right to change the equipment without asking permission for this specific change to the customer, because the customer should be interested only in the functionality and not in that equipment. And does the supplier exercise this right? If the answer is yes, there is the right to change, there is the supplier exercising it, it will qualify as a service contract. In other circumstances, it's a case-by-case approach, but in some cases, it will be qualified as a lease. Under IFRS rules, most of the, I would say all our lease contracts are treated as CapEx, as financially. So it's very important to know when you make your offer to customer, how do you build your contract or you do build your services? Of course, very important, the qualification can be different for the customer and for the supplier, because each of them has a different information, and based on his information, maybe he doesn't know all the prices, all the components, and he will qualify a certain way, which is not the same for the owner. For the customer, the same way, he will have to ask himself, is it a lease or is it not a lease? On the solution I presented last week, the product service system matrix. Maybe you know this system. It's a way to gradate the level of service in a contract. You start on the left side with very simple sale contract with limited services like maintenance. And the more you go to the right, the more you are in a use-oriented as a service model, or in a result-oriented service model, or in a full service model. Agoria and this project of energy as a service is going on the right side, which means that there are results obligations, and in most of the case, they are focusing on the energy and not so much on the equipment. In an equipment as a service, you will be in a building, and this scheme is also probably known by some of you, that there are the layers of a building. A building is built up with different, what we call skins or technical layers. Of course, the external surface is made of concrete, of foundation, and so on. It will have a very long structure, maybe 50 years, something like that. Then you have the walls. They are good for 20, 50, maybe more. And then the more you go inside, the more you will have short-term devices. Probably what is energy as a service will come to what we call the working functions of the building. So which with a life of 7 years, 10 years, maybe sometimes longer. And the more you go inside, like painting and so on, it will be short. But in this case, energy as a service will be average lifetime. And most of the case, it will be attached to the building. So I will not come back to the webinar that has been given earlier this week, but when your technical installation is attached to the building, there are some legal discussions arising about incorporation, about is it mobile equipment or is it becoming real estate equipment? And the solution you design has to consider this, and the contract you design has to consider this. So please listen to the webinar, you will know more about it, but very important to know when you are financing as a supplier your equipment, you will have the choice between several ways of financing. For example, you can have a factoring of your customer invoices, so the 60 or 120 customers invoices you made to your customer, you can have a factoring solution for that. You can have private equity and equity. You can have trade credits, short-term credit, long-term credit. You can have leasing. And I've made 2 slides. I will not go in detail. You will have the time to read it carefully after this webinar. But each of them has different characteristics in terms of which asset are you financing, which percentage of the asset, with which lifespan, which lifetime, which kind of security. Is it specific or is it a total portfolio? With which length? Are you in a fixed rate or in a variable rate? So depending on your own financial situation, depending on your characteristic, you will choose. Do I want a long term? Do I want a short term? Do I want a fixed rate? Do I want fixed rate? Do I want some guarantees like my company, or do I need to give only in guarantee specific assets that are given to this project? And of course, some of the characteristics are not compatible. So you need to choose one or the other, but you cannot have the best of both. I will focus a little bit on the lease part because, as I said at the start, you will have challenges of your balance sheet exploding, your debt exploding, and your revenue spread. So in some cases, the lease can be a solution for that. Basically, there are 2 ways to build a lease solution for your as a service model. The first one is what I will call back-to-back lease. What does it mean? Is that first, as a circular energy as a service supplier, you will have an end customer and you will have a relationship with this end customer, called or not leased, qualifying or not a lease or service, as I said before. But basically, you are delivering services, you are paid for those services, and you return the equipment at the end. And the customer doesn't know how you are financed. It's not his business. You are providing a service, he's focusing on the service. But you, I would say, in the coulisses, in the back, you can have a leasing partner, and this leasing partner will buy the equipment from you. So you will sell that equipment. You will have your upfront revenue because you sell it to him. You can have the cash, of course, because he's paying that equipment to you. You will pay a constant fee for this equipment for a certain life. And at the end, in most of the cases, you are interested to keep the equipment because you will give a second life, or you will refurbish, or you will give it to another customer. Certainly, if you have this right of substitution, maybe in some cases you will need the equipment which is as customer A, and you take it back to give to customer B. So it's back to back. It's between you and the lessor, and the lessee is not aware of it. In some other cases, if you need to outsource also the monthly invoicing and the credit risk, it could be, and also to reduce your debt, it could be that it's more attractive to have some kind of relation in your as a service between the lessor and the lessee. It means that some of the payments will be done directly between the lessor and the lessee, and the lessor will take the credit risk on the lessee. So it's less risky for you. Maybe it's less good on the marketing side. I will come back later on that, but at least it has several advantages: that you have no debt on your balance sheet, you can book your revenue immediately, you can outsource invoicing, cash collection, and credit risk, and in the same case, the lessor can help you at the end of the contract to reprocess the equipment to find the second life and so on. In that case, maybe you could have separate invoicing or combined invoicing for the services. Each of those situations has different consequences. If you are in a sale model, you book your revenue immediately. If you are as a service model without financing partner in the lease solution, you will spread your margin, your revenue and margin. If you are with a leasing partner, you can have your revenue and margin immediately. The same with your billing process, you do it yourself or you outsource. Cash collection and the debt and the credit risk, you do it yourself or you outsource. Your cash position will be better if you cooperate with a partner. Your balance sheet and the contracts, of course, they will be more complex if you have as a service than as a lease. That's the reason why Agoria made this workshop, and this standard contract is to help you to manage. In case of disputes, and that's something very important, I will come back later on that, it's very simple. If you are in a sale contract, once you have been paid, if it's not working at the end, the customer will have to go back to you and get money from you. In a service model, the basic rule is that when the customer is not happy, he has a trend to stop paying. Maybe it's not right to stop paying, but you know it's a power game, and if really not happy about your performance, he will stop. And stop paying has really significant consequences on yourself and also on your financing partner. So you will see that most of the financing partner needs to find a solution for what they call the performance risk. I will come back a little bit in more detail. The financing challenges, indeed, what are they? First of all, the performance risk. Most of your financing solution will need to cover that risk of performance. That means that if your customer is not happy, is still obliged to pay at least a certain percentage of the total. Most of the as a service contract do not allow the customer to stop completely paying because he has some equipment. Of course, maybe the performance and the energy saving is maybe not as high as he expected, but at least he has some heating, he has some airco, and is not entitled to stop completely paying. And in that case, your financing agreement needs to be very clear who is carrying the risk of stopping payment. And in some cases, you can find legal clauses that made the payment irrevocable. That means that the customer has to pay the financial institution, but he has a recourse on you as a technical supplier. and maybe you have in some cases to reimburse 10%, 15%, 30% of your monthly price because it's not working. But it's better to get 100% paid and to give back 30 than to get 0, of course. Second challenge in the bankability of the contract is that are you making one contract or two contracts? Of course, we had this workshop about the standard contract, and there was some kind of consensus from the suppliers to get one contract and to get really the perception for the customer, and it's more easy on the marketing side, of course, because you sell a responsibility, you sell a functionality to have only one contract. But even if you have one contract, it could be built in a main contract, being a service, and some appendixes that has the component and the flavor of something like a lease. And when you do this work, you will make your financing easier than if you have just a service contract. Sometimes it's some in the details, it's kind of perception, but it's very important to have this dialogue with your financing partner and with your customer to make your contract bankable and financeable. If you make the best technical offer, but you cannot financing it, then this energy as a service contract will not be a success, and it would be a pity. And really, you really have to find the right balance, take into consideration the interest of your customer, but take also in consideration the interest of your bankers, lessors, leasing companies. Also, if you make a joint venture with some equity providers, everyone wants to see which risk he has and which ones. To help you build a good file and evaluate the risk, there was a project to which Econocom participated, which is called C Evaluator. You will find it on the website that you see there. It was hosted by Vito, also supported and sponsorized by Vlaanderen Circulaire. So it's some kind of neutral evaluator tool by which the customer and the bankers, the equity providers can have the same communication tool and the same analysis of the project to improve the communication. And if you are interested in more of what I've said, we published a report 3 years ago, which go in more detail, and you will have some of the scopes. It's in Flemish, unfortunately, for those who don't speak Flemish, but it's available, and that's a good information. I'm available for questions. I think that all questions will be combined at the end, but don't hesitate to ask by chat or by question. Thank you.
Thank you very much, Christian. Yes, indeed, we will have a Q&A session at the end of the webinar. So thank you for all these insights, and now I will give the floor to Baptiste. Yes, we can see your presentation now, Baptiste. However, you're on mute. Just a second. Baptiste, you're still on mute.
All right, it should be
yes, it's
working.
Okay now.
All right. Sorry for that. I'm not able to join you with the laptop today. I'm on a tablet, so a bit of a technical issue. But thank you, Mira, and good afternoon. So thank you very much for having me with you today. So I'm Baptiste Desbois. I'm a senior clean / green tech advisor at BNP Paribas Fortis, and I'm pleased to explain you. Or at least to give you a flavor of how we see energy as a service solutions and how we try to foster them. So at BNP Paribas Fortis, I have the chance to work for a team that is called the SBCC. So that's the Sustainable Business Competence Center, where we have experts, engineers on many topics like ESG topics, circular economy, biotechnologies, hydrogen, CCU, CCS, renewable energies. And for instance, on my side, I come from the energy world. As you said, Mira, I have more than 10 year experiences in the energy sector. But I like to say that what we have first in common is a passion for sustainability. And what we do on a daily basis is to support customers in their transition, in their transformation to a more sustainable business model. So we are really here to help, to advise at company or of course at project level. And we also try to connect people with people or companies with companies because on the quest for decarbonization, we need each other. We need to help each other. And we're also here to assess the different projects from a technical point of view. So we are also technical experts. So we are checking all the technical parameters of any project that we are looking at. And we propose, of course, the right financing solution for investments. So today, I would say I'm very happy because what I see on a daily basis is a lot of energy-related projects on solar, wind projects, biogas, biomethane. We see more and more storage, electric mobility, and so on. But at the same time, we feel a bit of frustration because we don't see a lot of projects linked to energy efficiency or energy as a service at large. And I said frustration because I believe that is really a key pillar if you want to reach, for instance, the targets that are set by the Green Deal. So, of course, we understand why energy renovation or retrofitting actions are facing some challenges, some hurdles. It was mentioned before, it requires CapEx. The return on investment is sometimes quite long, and that's not the core business of the companies. But at the same time, making a building more efficient or more sustainable is quite important. First, to be aligned with the decarbonization targets. It's important to improve the value of the building, and it's also important, of course, to reduce the OPEX. And that's the reason why we as a bank, we stand as promoter of energy as a service solutions. We are deeply convinced of the potential, and of course, we would like to support this development. And as a bank, of course, we, but also from a client, or also from an ESCO point of view, we see different risks. If I take the case of an EPC contract, so energy performance contract, between a client and an ESCO, we can start drawing a long list. For instance, we can say on regulation, on market price, on climate. Or when it comes to the end client, there is a credit risk, there is an occupancy risk, or if we move to the ESCO on the right-hand side, there is also a technical or the performance risk on top here, once again, of a credit risk. So of course, we can find many other examples, but in an EPC contract, if I take a bit of distance, I can state that we are mixing risks that are first linked to the project itself, and then also mixed to the counterparties. And that is making the project a bit more complex to finance. Of course, at BNP Paribas Fortis, we have different solutions to finance a project. Of course, we have the classic investment credit for the end client. That's maybe the less expensive option. But at the same time, there is no guarantee on performance, and the client has to do everything on his own. We can also, that's another example, grant a credit to the ESCO, to develop energy as a service solutions. Here we have a guarantee on the performance for the end client, but it appears on the balance sheet of the ESCO. But we also developed a new product that I'm very pleased to present to you today. And this product is an answer from our side to try to lift up some constraints and some risks when it comes to energy as a service. This product is called EPC-FIN. That's for energy performance contract financing. So we start with a classic EPC contract between an end user, so on the left-hand side, and an ESCO on the right. The bank doesn't intervene in the commercial relation between the two parties. So the client is, of course, free to organize an RFQ, to negotiate and sign a contract with the best, the most suitable ESCO. The only difference here is the fact that the bank will purchase the receivables of the contract. And this will occur via our factoring department. So it means that the invoices will not be paid to the ESCO, but to factor, to the bank. So we take care of the payment that keeps a variable aspect. So the variability stays. For example, if the performance is not there, so the bank will discuss with the ESCO to retrieve the money. So it's not up to the client to do that in this specific mechanism. So it means that, I would say, first, one, peace of mind for the client. Two, we take the paperwork, we take the administration for us. Three, we remove risks from the ESCO perimeter. Why? Because we take the counterparty or the credit risk on the end client. So if the client disappears, it's not the problem of the ESCO anymore, it's the problem of the bank. Because we believe that the core business of the ESCO is to focus on energy performance and not on credit risk. Credit risk, that's the job of the bank. So it means also peace of mind for the ESCO. And for another point that is also very important is the fact that this construction, this mechanism could allow an off-balance treatment for the clients, but also for the ESCO. Of course, this will have to be approved or confirmed by external auditors first, but it makes it possible under certain conditions to have it off balance. And we believe here that we are also lifting up some important hurdles with this solution. So in a nutshell, we believe that EPC-FIN is offering a fair risk distribution. So first we have the client on the left, who is taking the non-technical risks, for example, on energy price, on occupancy rate. And then we have the ESCO in the middle, who is responsible for the technical performance risk. After all, that's the job of the ESCO. And then to the right, we have the bank that is taking the credit risk. So to conclude, maybe I would like to say that it's all about risk assessment. It's all about stress case. And to the question, how to make your application for financing energy as a service solutions, the question that was raised by Mira, I would like to point out that it's important for the bank to know, to understand the risks, to understand the impacts, what are the impacts on the different risks, to understand what mitigation measures could be. And at the end, it's not only important for the bank, but that's also very important for the client as well, to have a clear 360-degree view on the project. And here, I would like to draw a parallel with the other assets that we are financing. So at the beginning of this presentation, I said that we receive on a daily basis files to finance solar panels or wind turbines. And in that case, we perform stress cases. What about the business plan? if the production is low, if we work with the P90, so let's say a low volume of wind, or a bad year when it comes to solar radiation. What about the business plan in case of a low energy price? What about the maintenance contracts? What about guarantees if there is a technical issue? So the point I would like to make here is that it's more or less the same when it comes to energy as a service solutions. We can apply the same philosophy. For instance, what is the impact of climate risk? What happens in case of low technical performance, and so on, and so on. So the risk assessment and the stress case is key for us to increase, and it was mentioned in the presentation before, the bankability of the project, the credibility of the project, and help the bank to better understand what is at stake. And maybe once again, it's not only useful for the bank, but also for the client or the entity who is requesting financial facilities. So in a nutshell, once again, at BNP Paribas Fortis, we don't see, and I would like to say yet, a lot of energy as a service projects in comparison to the other technologies or solutions that we are asked to finance. We believe that the market is still lacking a bit of traction for different reasons. But at the same time, we believe that energy as a service is key to reach the targets, for instance, those set by the Green Deal. We are convinced by energy as a service solutions, and with our products like the EPC-fin product I just displayed, we are trying to help, to contribute, to foster the deployment of energy as a service. And of course, the last point, like any other project, it's important to map the risk and the impact if anything goes wrong, to increase, of course, the bankability of the project. So that's it on my side. Thank you for listening, and I will now try to hand over to Mira for the next part.
Thank you very much, Baptiste. Indeed, there is traction needed, and this is also why we are here. I would like to say. And yes, in our first webinar, we did discuss a bit about the market trends and the fact that there are a lot of, I would say, emerging projects or a lot of pilot projects in as a service business model, not necessarily efficiency as a service, but also efficiency as a service, but it's the scaling up that is taking time, and this is why we are here. We are here to support companies in this scaling up, because for the supplier's perspective, it's still quite a transformation, which is very challenging, and there is support needed, but there is also a need to perhaps inform and educate about this business model and see what we can do and what partnership can be created to reduce the risk perception from the supplier side, from the financing side, but also from the customer side. So hopefully through this project, we will kind of help scale up this business model. So thank you very much. And Thomas, I'm happy to give you the floor.
Thank you, Mira. I hope you all see my screen first.
Yes, we can see it.
Great, thanks. Okay, thanks, Mira. So indeed, now we are really going to move to the accounting parts of this type of arrangement. So first of all, let me share a few comments before moving to really accounting rules. With respect to those contracts. So the first very important point is that while the accounting treatment as such shall not be a business driver. So I guess Christian and Baptiste have shared a number of business related aspects, including financing and so on. Accounting is supposed to be just a fair, neutral reflection of what is the substance of the contract. Should not driving normally the business decision as such. However, it is fair to say that in some cases it can impact. So you may be facing as suppliers, let's say, customers that are really willing, for example, to have a solution which is off balance sheet for them. it can be a must in some circumstances. The next point I want to share is that, well, first of all, there are multiple accounting frameworks. And the rules with respect to the treatment of this kind of arrangement, let's say, are different depending on the accounting framework we are talking about. Christian already addressed, let's say, Belgium accounting rules, so Belgium GAAP. I'm more going to focus on IFRS or EaaS for public sector companies. So important to understand is that IFRS EaaS, let's say, compared to Belgium GAAP, is really substance driven. So the principle that we name substance over form. So meaning what matters is really the economic reality independently from the form of the contract. So you can name a contract a service contract. If in substance it is a lease, you'll have to treat it as a lease under IFRS, which is less the case in the Belgium GAAP, which will be more form driven, which is sometimes, yeah, at least from some perspective, more comfortable. Multiple perspectives as well. So I already, it was already mentioned that, well, the rules are not necessarily the same for the supplier and the customer. That's one perspective. It could also be that the supplier and the customer are not using the same accounting rules. You as a supplier can maybe use IFRS requirements and your customer still Belgium GAAP or whatever other accounting rules. That's one thing. And also, you should not necessarily assume that your customer wants to reach a certain accounting outcome. I mean, there are some companies, some customers that maybe are more sensitive to the level of their EBITDA, for example, which typically goes together with a lease treatment. So in some cases, it could be that your customer is favorable to have a lease for the equipment part. So it really depends. Next comment is that, well, these accounting aspects are quite complex and involve quite a certain amount of judgment. So of course, let's say that's something that needs to be anticipated and also yeah, carefully analyzed based on the specific situation, also depending on the different dimensions I shared already. Okay, so moving on to, let's say, what I tried to summarize in this slide, which is, well, what are the big accounting questions for the supplier using IFRS rules as a guidance? So as I mentioned in the introduction, I'm going to focus on those requirements. So basically, the audience, I guess, is mostly representing, let's say, the supplier side. So let's say there are two big questions, if I can try to summarize the accounting consideration. The first one is, of course, whether the equipment part of the arrangement, because in efficiency as a service, as already mentioned by Christian, you always have, or yeah, in virtually all the cases, an underlying equipment, tangible asset that is being used, let's say, to deliver efficiency as a service. So whether that asset meets the IFRS condition to be treated as a finance lease, yes or no? And I insist it's not sufficient that it's a lease, but it should also be classified as a finance lease. In that case, so if the answer is yes, which is not so frequent, so if the answer is yes, there is a finance lease embedded into the agreement, then let's say you as a supplier, you will actually account as if you had sold the asset, let's say like in a traditional sale model, so with revenue recognized immediately. But of course, because it's a financing transaction as well, you are also to some extent a bank, or maybe you will connect with Baptiste to get this financed. But if not the case, then you also have a receivable then on your customer, which is the lease receivable, and from a P&L point of view, you also have an interest income on that receivable. Okay, so from an accounting point of view, as a supplier, if under IFRS, and I will come back to the underlying rules, if under IFRS the conclusion is that there is a finance lease for the equipment, then you have a normal sale with revenue attached to that, I would say immediately, and a finance income on the lease receivable you have on your customer. Then if the contract does not contain a finance lease component under IFRS, then let's say the equipment parts, the revenue attached to the equipment part will essentially be recognized over time. So not at the beginning, but over time, basically over the duration of the contract. So as Christian already mentioned, so it means compared to a normal sale model, you are going to defer the amount of revenue, not to recognize it immediately, but over the contract period. I'll come back on this notion of what is a lease versus a service contract and a finance lease. The second question, which we experience especially for, let's say, when there is an important installation, configuration, customization part in the contract, is whether this portion or this part of the agreement, so the service attached to the installation configuration, should also be recognized when the service is performed, so meaning at the beginning of the contract, or whether it should also be recognized as revenue over time, so over the duration of the contract. This is essentially a problem. I will come back to that for the customer, but might also be important for the supplier. And so there are also complex rules which are more connected then to the revenue recognition standard, so IFRS 15, not IFRS 16, which comes essentially, and I will come back to that, to the question, is the installation, configuration, customization services, if any, of course, provided at the beginning, is that viewed as a sort of separate deliverable from the rest of the services that you are providing as a supplier? I'm trying to simplify, but if the answer is yes, it is a sort of separate service from the recurring one, then you will have essentially to what we call unbundle, so disaggregate your contract and say, okay, I have different deliverables, maybe one equipment which is leased, maybe one recurring service where I recognize revenue over time, and maybe one initial installation service that I have to recognize immediately, let's say, at the beginning when I provide the related installation services. That can be quite challenging because you also need to allocate the total price of the contract between the different components based on the economic reality, so not which may be different from the contractual values. So that can be challenging. Then, of course, if there is no such installation configuration services, or if they are not distinct from the recurring ones, then essentially the service linked to that will be also recognized over time, over the duration of the contract, which may be, from a cash point of view, also a concern, because of course those services, you have to pay for them, you have to incur those services at the beginning, but you will only recognize revenue attached to that later, and also have to finance this mismatching, let's say, in cash flows. So if I try to summarize for the supplier, I guess these are the two big questions, which all ultimately address the question, when shall I recognize my revenue attached to those services? At what moment? Is it over the contract duration, or is it at the beginning, whether it's for the equipment or for initial services provided? When it comes now to the customer, if my computer is okay, yes. For the customer, which of course is not your direct concern, but can be, of course, indirectly, because your customer may have some requirements in that respect when entering into negotiation with you as suppliers. Of course, the most obvious question is also the question of whether there is a lease in the agreement. So whether let's say, the equipment component in the contract, in the arrangement, meets the definition of a lease. And from the perspective of the customer, so the lessee under IFRS, let's say the only question is whether it's a lease. You no longer have this question, is it a finance lease or an operating lease? Under IFRS, each and every lease contract has to be recognized on balance sheet independently from this old classification that existed and that still do exist for lessors. So there, of course, if the answer is yes, there is a lease under IFRS 16, then the customer will be obliged to recognize on balance sheet, let's say, only, that's important, the fixed or committed lease payment. So if you have a lease contract that is purely variable, so for example, a renewable energy type of contract, whatever, solar panel, but the energy that you purchase with those solar panels as a customer is purely variable, meaning you're exposed to the quantity of sun that's gonna shine over the year. Well, from an accounting point of view, we'll consider this as variable, and so the customer will not have a liability for that because it's variable. So it's only the fixed committed payments that would sit on the balance sheet of the customer. Important to know as well is that, as I mentioned in the introduction, it can be, for some customer, not a good thing that the equipment is on balance sheets, but some others may find it interesting because it has the effect to increase the EBITDA of the customer. So meaning, if the asset is on balance sheet, it means that you recognize an asset and you amortize it, and the amortization is below EBITDA, so it's not negatively impacting the EBITDA. Whereas if it's treated as a service, as a pure service, the entire payment that is being made by the customer negatively impacts the EBITDA. So again, important to understand what are the drivers of your customers. So then, if there is no lease, well, the equipment is not on the balance sheet of the customer. It's essentially purely viewed as a service of balance sheet with, as I just mentioned, a negative effect on EBITDA. The second question that we see, and we see that a lot for the moment, I can tell you we have quite some discussion about that for software as a service, but I suspect this is also valid for efficiency or energy as a service, is the extent to which, as already mentioned, there are installation, configuration, customization services. And therefore, the customer, let's say, that's even another problem, because there you can really have a problem of mismatching. So if, of course, there is no such services, there is no mismatching risk. Now, if there are such services, you need to determine as a customer when you should expense those services received from the supplier or from a third party, because sometimes the installation can be provided by the supplier itself or by an agent of the supplier, but it can also be provided by third party or even its own employee of the customer. So depending on the situation, can come back on this quickly, it could be that the customer has actually to expense immediately in its P&L those installation services, even before, let's say, the go live, I would say, of the agreement, which is of course a problem. Let's say to have the expense before the benefit of the agreement starts. So there, it's essentially depending whether it will be recognized immediately as an expense or spread over the duration of the agreement. Essentially depends on the same question, whether that installation service is viewed as a separate deliverable, as a distinct performance obligation, to use the terminology of IFRS 15, which is the same question we had for the supplier. And if the answer is no, it's not a separate service. I have purchased as a customer a full option, I would say, service combine in one contract, then basically you are fine. You don't have mismatching problem because you will actually spread the total cost, including that installation service, over the contract period. If now it is viewed as a separate service, the installation, you have to expense it immediately, to make a long story short, or if that service is provided by a third party or your own employees. This is the case. I hope it will not be confusing. This is the case, all those considerations, when we are outside the lease accounting. So the benefit of being in a lease accounting is that you have an asset to be recognized under the lease model. Then you can capitalize the installation cost that you may have to incur within that asset that you have, and therefore amortize that over the lease period. You don't have the mismatching problem in that case. So the discussion I'm referring to on the initial installation cost for the customer is essentially valid when you conclude on the first question that there is no lease. Otherwise, you have the possibility to capitalize, let's say, the installation cost as part of the leased asset. So these are the big questions. Now, what are the underlying rules? Yeah, I'm not sure why this is disappearing. Okay, sorry for that. You had on the left the definition of what is a lease. That's not that's the conceptual let's say definition, where, as mentioned already by Christian in the introduction, basically a lease is the right to use an asset, more specifically a tangible asset. So lease is not applicable to intangible items. So we are talking about tangible assets over a certain period in exchange for consideration for payments. What is key in distinguishing a lease from a service contract, and you have the decision tree here coming from the standard. I'm not going to go through all the details of that because it can become very complicated. But the first and very important question is that there is an identified asset, again, tangible asset, which means that the contract, the execution of the contract by the suppliers, depends on a specific identified item, so which is essential for the provider, for the supplier to provide the service that is committed. And the supplier does not have the opportunity to substitute the asset with another. So if the supplier is in a position contractually while still providing the service to substitute an asset by another, and that would be beneficial, let's say, for the supplier to do that, there can be examples of that. Well, then you don't have an identified asset, you are immediately outside the lease accounting. One of the key conditions to have a lease is that the agreement relies on the existence of an identified asset that the supplier cannot substitute unilaterally at its own benefit, I would say. The second condition is that, so if there is an identified asset, is that the customer basically have the right to obtain all the economic or substantially all the economic benefit from the use of that asset over the period, over a certain period of time. To give you an example, if you are in a solar panels type of agreement, you can have different outputs, of course, the electricity that is produced, but also the green certificates that are being produced thanks to those solar panels. That will be considered as being an economic benefit that is being produced by the equipment. If the supplier, for example, keeps the green certificates, which are certainly having a substantive value overall, but the electricity is sold to the customer, we will consider that this condition is not met. So because in substance, the customer only gets one of the output of the asset being the electricity, but not another one which is substantive, being the green certificates. So then we would say, well, the customer does not obtain substantially all of the economic benefits of that asset over the period of use. So if you say yes to that second condition, then you enter into essentially the question of who has the right to direct how and for what purpose the asset is used. Who is really, let's say, deciding how to use the asset and for what purpose. Typically in energy as a service or efficiency as a service contract, there are not much decision to be taken in that respect. So it's not like with a car where you have to decide, okay, what do I do with that car? Where do I drive with it? If you put solar panel on a roof, okay, there is not much decision but to wait for the sun to shine and to collect electricity out of it. So so that's why in a lot of cases you are in that decision tree in a situation where it's neither the customer nor the supplier who is actually deciding, let's say, how to use the asset. It depends, of course, on the nature of the equipment being subject to the agreement. If you are in that situation, ultimately, you have to check, let's say, who has essentially designed the assets for the needs of whom. So if you have designed the electricity installation for the specific needs of the factory, of the customer on which whatever the installation is located, probably you will be in a situation where the design was made by the customer and then you end up in a lease. Otherwise, you end up into a service contract. So as you can see, without entering into much details, the question of whether a contract is or not a lease under IFRS is quite elaborated, with many questions to be addressed, starting with the notion of identified asset, but also economic benefits and power, or let's say control over the use of the asset. Okay, moving on. So this last slide is providing some guidance to determine whether installation configuration services are distinct or not, are viewed as a separate service from the recurring one. And looking at the bottom of that slide, so the first part is really what the standard IFRS 15 is providing as a principle in that respect. But in more practical terms, and usually I would say would be in that situation. So when the supplier provides a significant service of integrating the different components of the offering, so the installation, the design, the maintenance, and so on. So when there is a strong degree of integration of those different components, typically you will consider that installation is not distinct from the rest, and therefore, let's say, from the perspective of the customer, it means that you don't have to expense those costs immediately. You can spread those installation costs and service received over the life of the contract. And for the supplier, it means there that you cannot recognize revenue when you perform the service, but there as well over the duration of the entire contract in terms of revenue recognition. There as well, this is quite judgmental. It depends on the specific facts of the contract, but let's say to give an indication, frequently, let's say this is not viewed as distinct in practice. Voilà, so in the limited time frame and leaving some room for questions, that's the essential points I wanted to share with you. Repeating, let's say, what I said at the beginning. So let's say accounting is only there to reflect the substance of what has been agreed contractually between the parties, not to influence those business terms. Make sure you understand, let's say, your own, let's say, consideration to keep your accounts in terms of revenue recognition essentially as supplier. And what are the concerns of your customer for their accounts, depending on their accounting rules? And yeah, anticipate those questions, because typically it is looked at the end, I would say, when it's too late. And sometimes it can be a blocking factor for some customers, at least in the overall picture. Voilà. Thanks for your attention, Mira. I give you back the floor, and probably for questions potentially.
Yes, thank you. Thank you very much, Thomas, for taking us through all these rules. I will give the floor to Dimitris to handle the Q&A session.
Thank you very much, Mira. And thank you first to all our panelists, so Thomas, Baptiste, and Christian, for these very interesting presentations. We do have a few questions that came in, so I'll jump directly into it. The first question is for Christian. So is the distinction between lease and service according to Belgium law similar or the same in, for instance, the Netherlands?
So thank you for the question. What I know is that in the Netherlands, most of the company report under IFRS, and there is not so much local accounting left. So I would say most of what Thomas has said is applicable in the Netherlands.
Yes, agree, Christian. So if the question is an accounting question, because of course you can also have a legal definition of a lease versus service, but that I leave that to you, Christian. But from an accounting point of view, agree that in most of the cases in the Netherlands, IFRS is the benchmark. And in such a case, indeed, what I've just discussed is applicable.
Okay, okay, many thanks. And I think then,
sorry, just to add a thing. Also, in the efficiency as a service project, as mentioned, the project is taking place in the Netherlands. So we have our consortium partner in the Netherlands that developed a standardized contract, and that looked also into the accounting implication. So I think on the website you should be able to download. Actually, I don't know, Dimitris, if these reports, the accounting implication reports are on the website, but in any case, you can contact us and we can send you the reporting with regards to the accounting implications for Netherlands as well.
Totally, very good points. Yes, and then I'll follow up with a question for you, Thomas. It's if different accounting standards are used by the supplier and the customer, which combinations are beneficial in which situation?
Well, that's not an easy question, and of course you can elaborate many different scenarios. But yeah. Well, what can be viewed as I would say, as the goal, depending, of course, on the specific of each party, is for the supplier, let's say, to recognize revenue immediately, not necessarily over time, depending on the situation. But that could, let's say, be the case if the supplier is reporting under IFRS. Based on what we discussed on finance lease classification, whereas on the other side, if your customer is Belgium client reporting under Belgium GAAP, it could well be that the same contract does not qualify as a lease or not as a finance lease for the customer, which would mean that for the customer it would remain off balance sheet in the Belgium GAAP accounts. With the cost being spread over time, which is in a lot of cases what the customer prefers, let's say. So in I would say a sort of standard case, which could be beneficial for both, is that the suppliers under IFRS recognize revenue immediately as a finance lease for the equipment part, whereas the customer is in the Belgium GAAP and recognize the cost over time of balance sheet. But of course, as mentioned, each case to be analyzed and the drivers of each party to be considered in every situation.
That makes sense. Next question is for you, Baptiste. What would be a typical ticket size for a BNP Paribas EPC FIN project?
Yeah, that's a very good question. We say that below 1 million euro, it's maybe too complex. But we have a sweet spot, I would say, which is a few millions. So, for instance, 2, 3, 4 million is our sweet spot. Knowing that can be a bit less, can be more. But yeah, Just in a nutshell, below 1, it's maybe too small for this construction. 2, 3, 4 is perfect, but it can be much higher.
Okay, and connected to that question, I guess, is also for EPC Fin. Is it necessary to always be disclosed as lease, so end customer pays to financing partner?
So that's the way we see it. That's the way we constructed this product. So I would say yes here, but you have to know that it's a new product. Of course, we are open to discuss any other construction if it helps the market. So I would be happy to know what is the reasoning behind. But in the proposal that we have on the table is like this. And for us, it's important to know the end client, because we take a credit risk on the end client. So it's important for us to know who's behind.
Mm-hmm. And so that person had 2 questions in one. So the follow-up is off balance. Is it possible? So understood that it's possible for both the end customer and ESCO. And in that case, on which balance sheet the assets will be presented?
Well, that's at the end, that's the bank. Yeah, that is, for instance, if you are saving like 400,000 euro per year, and you have an installation of 5 million, so we are purchasing the receivables over 10 years to join the two. So it's not on the balance of the end clients, not on the balance of the ESCO. EPC Fin is a way to let's say to finance the installation with this workaround, I would say. Yeah. So we are taking this investment for us.
Okay. And I'm going to read the next question. Is also for EPC Fin. Can be off balance for ESCOs under certain circumstances. Could you elaborate on some of those circumstances?
Yeah, so a lot of interest for EPC Fin. Nice to hear. So we worked with the consultancy bureau to define the conditions, knowing that there are conditions. So we are just setting the scene to make it possible, because everything has to be approved at the end by auditors. But we are making everything possible to reach that. And there are 4 conditions. The first one is that the EPC contract has to be 100% variable based on performance. So it means that if there is no performance, there is no payment. But that's the philosophy of EPC Fin. So that's an easy one. The second one is the fact that if there is a floor, it's not off balance anymore for this floor. But here, by construction, there is no floor. The next one is the fact that the criteria that is used to define the performance is defined by the ESCO. And of course, that's the fact. It's not up to the bank to define the performance because we are talking about technical things. And the last one is the fact that it concerns only the technical aspects. For instance, energy prices, the utilization rate, and so on, are not relevant to calculate the technical performance. So everything has to be based at the end on technical aspects. So if we tick all the boxes, it makes it possible once again to be checked, approved by auditors to have it off balance.
Okay, many thanks, Baptiste. And Mira, I see we have 1 minute left, so I think I'll give the floor back to you. And for the questions that were not answered, we are collecting them, and we'll try and send a written answer to those.
Okay, thank you very much, Dimitri. So maybe perhaps I'll take the extra minute to address the last question. Because you've mentioned that you talk about energy performance contracting. So the question, but there's actually 2 in 1, is the solution also available for energy service contracting? And also what about agreements where you have variable payments? Is this which are not defined from the beginning? I assume in performance contracting, the payments can be variable because you don't necessarily know from the start what the savings will be.
it's all about variability, because if there is no performance, there is no payment. And then if there is no performance, it's up to the bank to go back to the ESCO to retrieve the money. So it's all about variability here in this mechanism, and that's the reason why it opens the door to off-balance treatment.
Okay, so thank you very much, Baptiste, and thank you again to all the speakers, Thomas and Christian, for your presentation. So I'm concluding our third and final capacity building webinars. If there are some other topics that you would like us to address in future webinars or workshop, please do inform us. Also visit our website to download the toolkit that we've developed. So you have also, as I mentioned, the contract for Belgium, but also for the Netherlands and for Spain. And if you're interested in either developing efficiency as a service or being an enabler of efficiency as a service, also do reach out. We are creating a partner page, the aim of which is to provide visibility to efficiency as a service suppliers, but also enablers. And what we want to do is basically support stakeholders in the development of such a business model, but also in the scaling up of efficiency as a service. So thank you very much for your attendance, and we keep in touch. Have a great afternoon. Thank you.
Goodbye.
Thank you, everyone.
Goodbye. Thank you.
Everyone.
Bye-bye.
Bye.